Hi, I'm Soumya, CEO and co-founder of Nuveaux Trading. Just a bit of a quick background. I'm not sure how many of you know, but I did my PhD at Cornell under Goon, and I looked at sort of cryptocurrency and blockchain from a bunch of different lenses, from distributed systems to crypto economics and computer security. I also previously was a co-founder of Blockshot Labs. And I'm here to talk to you today about the holy grail of order matching. So, guys, I've done it. I found the holy grail of order matching. This is the best order matching system that you could possibly ever think of. All right, it's done. We can pack it up and go home. Before I tell you what exactly it does, I'm going to tell you how I found it. And the way I did it was I sat down and I just listed every single problem that you guys can think of with today's order matching systems. So MEV, solved. Slippage, done. LVR, taken care of. Front running, sandwich attacks, impermanent loss, done. EQR, done. At this point, you might be thinking, what the heck is EQR? You also might be thinking, how could he possibly have done this? And what I'm here to tell you is that's not the point of today's talk. I'm not here to present today the holy grail of order matching. This is actually the wrong approach. And the reason this is the wrong approach is we shouldn't be looking at how do we solve today's problems, but we should be taking a more foundational look. And that's really what today's talk is about. It's about how do we go about finding the holy grail of order matching systems. And what I'm going to argue today is that we need to first develop a foundational understanding of how exchanges work and the different features around them. And then, using that foundational understanding, we need to develop benchmarks so that we can actually compare different exchange mechanisms and see how they do. So that if you have a particular mechanism that you think is good and someone else does, there's like a fair common way to actually compare them and say, hey, like which one is doing better. This is sort of super high level and fluffy. So I'm going to go into something very concrete and I'm going to talk about spreads, right? So, and this is just one aspect of exchange design. There's a lot of literature and research and everything done on many different things. That's like a course, not a 20-minute talk. So I'm going to ask the basic question. Do we need a bid-ask spread? Is a bid-ask spread just like a remnant of greedy market makers trying to extract value from customers? Or is there something like fundamental here? And if there is something fundamental, what are some factors that influence the size of the spread? Right? Like, why does it get bigger? Why does it get smaller? What things kind of contribute to that? So to do this, we're going to start off with a very, very simple exchange model. So we're going to strip away a lot of the complexities of modern exchanges so that we can really start examining this question. So I'm going to assume there's some kind of incoming order flow. So the exchange will see some sequence of buys and sells. We have a single benevolent market maker. So we're removing here the market maker profit incentive. So the market maker is not trying to make money. They're just trying to like sort of stay in business and service the incoming flow. And the third thing I'm going to do is I'm going to remove the price fluctuation as a factor. So the price is fixed. So imagine one Bitcoin is worth $30,000 at the beginning of time, and it always is that. So it will never, ever, ever, ever change. Okay. So in this model, do we need a spread? Because you know the market maker is not getting screwed. If I trade with Nick for 1 BTC for 30,000 USDC, he didn't make a profit, I didn't make a profit. So can the market maker just kind of service that order flow pretty happily? So to carry this out, let's think. Suppose we have absolutely no spread. What actually ends up happening? So if we look at the market maker, they have some kind of inventory. So they start with some Bitcoin and some USD. It doesn't really matter what the amounts are. And they go bankrupt or fail if either the Bitcoin balance or the USD balance goes to zero. Okay, so they're just trying to stay afloat. And again, no profit motive. So to avoid failure, we can just write down an expression for what the Bitcoin balance is at any point in time. So the Bitcoin balance is just the initial balance minus the sum total of the Bitcoin buy orders up until that point. Because whenever it services a buy order, you give the client some of your Bitcoin and you get back USDC. And similarly, you add the sell orders. So this is the expression for Bitcoin. The expression is completely equivalent for the USD side. And to avoid failure, again, the balance must be greater than zero. So there's a well-known problem, I'm not sure how many of you are familiar with, it's called the gambler's ruin. And what this basically says is with no spread, failure is certain. And the reason for that is you can look at their Bitcoin balance as like a random walk where they start at some balance and they just walk up and down according to which trades they happen to service at that point. And what's the probability of them crossing the zero line? And if you walk long enough, the probability approaches 1. So spreads, if you look in this scenario, they actually reduce the probability of failure. There's no way to eliminate the chance, but with no spread, you will fail. And with a spread, you might not fail. So this actually shows you something really intrinsic about like spreads and why market makers charge spreads. If you have spreads, there's no adverse selection. A benevolent market maker, you remove the market maker profit incentives. And even then, even in this simple model where you kind of remove like the commonly thought reasons behind a spread still comes up and there's a reason for that spread. The core takeaway is one contributor to spreads is the inventory risk that's taken by market makers. And in some sense, if you look at what AMMs do, like the basic like XY equals K AMM, it's really looking at managing the inventory and making sure that you never fail. Now, let's make this model a little more rich. What if the price changes? So again, you have the incoming buys and sells, you have the benevolent market maker, so we're removing the market maker profit incentive. But now, instead of having a completely fixed price P, the price starts at P and then moves to P prime. So P prime, so imagine like Bitcoin starts at 30,000, it either moves to 45 or 15. And crucially, some traders will know the value of P prime and some traders will not. And crucially, the market maker will not, because if the market maker knew what P prime was, they could just update their prices accordingly and they'd be fine, and this model would have no value. So let's think about the properties of the order flow that the market maker is facing. Informed traders now have an explicit profit motive. If the market maker is quoting at 30, and the informed trader knows that the true price somehow is 45, right? They'll be buying all day long. They're not going to be selling to the market maker, right? So all of the informed traders are on a single side of the order book, either the buy side or the sell side. So what that means is that the original order flow is unbalanced at the original price P, right? So the market maker needs to do something to respond to this problem. So the way they do it is you can construct this tree, which essentially says you start off with the original price and it either changes up or down, depending on if there's good news or bad news. And the market maker for each trade, they're either trading with an informed trader or they're trading with an uninformed trader. If they trade with an uninformed trader, the uninformed trader may buy or sell at some kind of price. The informed trader will buy if the new price is higher and sell if the new price is lower. And they'll do that with probability 1. So you can essentially look at the probability of a buy and a sell, and you can use Bayes' rule to update the price. The theory that this is based on is quite old, so it's this Bayes' rule. You can imagine modern market makers using like more sophisticated models in order to like figure out how to update their price. And the interesting result here is that the spread compensates for losses on the informed trades. So the market maker, anytime they're trading with an informed trader, right, they know something about the price that the market maker does not, and they're losing money on that trade. And they need to charge the uninformed traders a spread so that they don't go bankrupt, right? Or else at every price movement, the market maker will be at a net loss. So a few interesting takeaways here. The market maker has to extract information from the order flow. So when we're doing exchange design, right, that's actually something that's kind of important to think about. This mechanism also shows how price discovery and prices get incorporated into an order matching mechanism. And spreads here happen due to adverse selection. It's because I don't know if the person I'm trading with as a market maker is informed or not. So I need to charge a spread in order to sort of compensate for the risk that I'm losing money on that trade. So what have we learned so far? So I baited you guys into saying that I had something, but that's not quite what this talk was about. A second takeaway is hopefully you learned something about why spreads are caused and a few of the underlying issues there. The third thing I would argue is the most important, and that's about standard benchmarks. And the reason is, in many, many fields, including Web3, we optimize what we measure. And the current measurements that we're really taking on order matching systems are about symptoms of problems like MEV, impermanent loss, and so on and so forth, like that giant list I presented at the beginning. And what I'm saying is we really need to start asking what makes a good order matching system and what properties do we want a good order matching system to have, and start building towards that. So what I'm going to propose today is just a very simple benchmark based off of the results I presented. And suppose you have some order matching system that you think is the holy grail, right? Like this is the one to end all order matching systems. And now just have a thought experiment and have an analysis. Bitcoin starts at $30,000 and it's been trading at 30,000 for a while. And then all of a sudden the price goes up. It's now 50K. How fast does your system converge? What does your system and order matching algorithm do? Who loses money? Who gets money? And does that make sense? Is that reasonable? And this is a very qualitative analysis. I'm sure as we sort of keep thinking on this and looking at more, we'll come up with more quantitative and better analyses. But let's just run this thought experiment through a club with the results that we've done so far. So the price information is updated based on the fastest market maker. Whoever figures out what P prime is first is going to be like the winning market maker on a club. Uninformed traders are losing money because the market maker is essentially taking money from the uninformed traders. And informed traders will get money until the price converges. So in essence, if you're thinking about the flow of money and what's actually happening, is you're actually paying informed traders for their information, which seems like a pretty good result, right? So there's usually a lot of demonization I see of like informed traders and so on, but a lot of them are providing a service. If you look at an arbitrager, in some sense, they're providing a service to an exchange where they're incorporating price information from other exchanges into your trading venue, right? So what's the path forward for us? So crypto has already revolutionized the settlement layer for finance. We kind of see like these regular announcements of some major bank or some fund or someone tokenizing their fund and putting it on the blockchain, or looking at blockchain-based settlement systems and so on. This seems like it's something that is very imminent and on the horizon. Trade execution, I think, is next. I think there's still something for us to contribute in how we redo trade execution compared to how TradFi does it, and in some way that's equivalently revolutionary. I hope the short talk just kind of convinced you. This requires more foundational thinking and not just thinking about, oh, like I'm trying to solve XYZ problem. Just really taking a step back and looking at what are the core properties that we want out of an exchange? What is the role that each player is playing? And are we compensating them appropriately? Are we designing a mechanism that is fair for everyone? With that, I want to conclude. Thank you very much for listening to my talk. This is my email and Twitter, and I'm working on a project in Nuveaux Trading. We're still in stealth, but if you want any updates, like I'm happy to chat offline.